I think it's pretty safe to say that nobody likes paying tax. Over the past year or so, millions of new investors have started to dip their toes into cryptocurrency. Now, during this time, I can almost guarantee that people would have definitely sold some, if not swapped what they were holding for other cryptocurrencies. And depending on if they made a profit or a loss, tax would definitely be owed on that money. Welcome back to my channel. My name is Reese, and in today's video, I'm going to be going over a general guideline of what to expect regarding cryptocurrency and the tax implications involved. I have to start this video by saying, just remember that I am not a financial advisor and this is not financial advice. Everything that I talk about is based on my own research and opinions. You need to come to your own conclusions by doing your own research, especially with things like this. Depending on where you live in the world as well, one thing to note is that the rate that I'm going to outline is based on Australian tax law, but it will be very similar in nature wherever you are in the world, and you'll be able to find the specific rate once you understand the key concepts just by simply Googling the rates of what I'm about to talk about. So keep that in mind. Let's get into it. Because cryptocurrency is still somewhat unregulated, it may be tempting to avoid your responsibility to declare profits made from your crypto investments. What I'm about to say is a fact. This is not speculation. The tax office is absolutely looking to catch people who are avoiding their tax obligations regarding any asset, not just crypto. And it's easier for them to catch people doing the wrong thing than you might think. In Australia, for example, cash deposits of $10,000 or more must be reported to AUSTRAC within 10 days. This includes cash deposits of $10,000 or more into an Australian bank account. AUSTRAC is the Australian government agency responsible for detecting, deterring, and disrupting criminal abuse of the financial system. And for a tax audit purpose, the Australian Taxation Office is able to access any reports made to AUSTRAC. So regardless of if a crypto exchange is required to report your transaction history or not, a bank definitely will, especially if you're someone who's made a decent profit, which I know plenty of people who have here in Australia anyway, and you see it online left, right, and center. If they were to sell their cryptocurrency for fiat currency on the exchange and then withdraw it to their bank account, your bank would probably have to report that to AUSTRAC. And if you were to get audited by the tax office, they would be able to ask, have you paid tax on this money? And if you haven't, you're in trouble. So now I'm going to actually take you through the two examples that I think are most important and most relevant to cryptocurrency holders, and hopefully it makes a little bit more sense coming out of it. Because cryptocurrency is now classed as an investment, there are a few things that you could do which would trigger a tax event, resulting in either a capital gain or a capital loss, which would need to be included in your financial year's tax return. I've actually already made a video discussing capital gains tax within Australia, so be sure to check it out if you're interested. The link will be in the description below. But in short, if you hold an investment for over a year within Australia, you will pay tax when you sell it on half of the profit. If you sell that investment before 1 year has passed, you will pay tax on the entire profit. And a capital loss is the same thing, but in reverse. If you sell an investment for a loss, you will be able to claim that loss as a tax deduction. And I have to be specific here, you'll be able to claim that loss as a deduction on your tax only for other capital gains you make in that financial year. What triggers a tax event resulting in either a capital gain or a capital loss scenario is the moment that a transaction occurs, whether you sell some, you swap some, you gift some, or you buy goods and services with your cryptocurrency. This concept is really important to grasp. Note what I just said there. Even if you swap one cryptocurrency for another, that will trigger a tax event, resulting in either a capital gain or a capital loss, and then ultimately you having to pay tax on that tax event. Just as a really simple example, if you took $1,000 and invested that into Bitcoin, and then 3 months later, that was now worth $3,000, and you decided to swap from Bitcoin, all of that Bitcoin, to Ethereum, you have now triggered a tax event. You have made a capital gain of $2,000 because you took your end result, so $3,000 is what it was worth when you swapped it, minus your initial investment of $1,000. So you've made $2,000, a capital gain of $2,000. You will have to pay tax at your normal tax rate, and you have to pay tax on that full amount, that full $2,000, because you sold it within 1 year of holding it. You don't get to get the capital gains discount here in Australia anyway. So you have to pay tax at your income tax rate on that $2,000, which if you live in Australia, the average is 32.5 cents on $2,000. It's going to be around about $600 just for swapping one coin to the other. Simple example. Hopefully that made sense. One other important thing to note is that each coin and token is assessed separately, even if they're held in the same wallet. The other thing that needs to be mentioned in this video is another common way that people earn passive income through holding cryptocurrency. This is via staking, airdropping, and mining. So firstly, people who receive rewards in the format of cryptocurrency for staking is classified as ordinary income equal to the money value of the tokens at the time they are received. And the same goes for projects that airdrop new tokens to their holders. Let's use VeChain as an example. You passively earn VETHO for simply and literally holding VeChain tokens in your wallet. Be sure to check out the videos I have made on the topic of VeChain if you're interested in the project. It's one that I back and one that I really like. Links are down in the description below, and please do me a favor while you're down there and hit that like and subscribe button. It really helps the channel grow. And the money value of an established token received through an airdrop is assessed as ordinary income of the recipient at the time that the token was received. Now I'm going to break this one down into a really simple example to understand as well, and it's important that you do understand this. As an example, let's say I hold VeChain tokens and that I have held them for years. Every month since then, I have received VETHO tokens as a passive income stream through holding VeChain tokens. The money value of those VETHO tokens I have received is assessable income at the time that I received them. And the cost base of those airdrop tokens will be the market value at the time that they were received. You can easily check the price of a specific token at any time since its inception using a website like CoinMarketCap to work this out. Again, I've left a link down in the description below. So if you never declared this and got audited, you would absolutely need to pay tax on that income based on the financial year that they were received. Your tax bill could theoretically be enormous. This is where it really starts to get scary. Imagine this scenario playing out. Let's say in March of last year, you bought around about $35,000 AUD worth of VeChain, which would give you about 20 million tokens. You gain approximately 0.000432 VETHO per VeChain token per day. If you had 20 million VeChain tokens, you would get roughly 250,000 VETHO per month. Now, for the month of April of 2021, you would have received about $10,000 worth of VETHO in Australian dollars in this scenario. That $10,000 at the average tax rate in Australia would see you owing around about $3,300 just for April. If the price of VETHO tanked, you would technically still owe that tax but not be able to sell your VETHO to cover the cost of that tax because the coin is now essentially worthless. You would essentially pay tax on the price that you received those tokens at, but now not have any value in holding those tokens, leaving you with a relatively uncomfortable or potentially uncomfortable tax bill. This is why crypto is still a relatively scary space to be in, because you can pretty much get screwed simply for holding something or trying to invest into something. Not trying to scare people, you just need to understand this. It's why it's so important to understand. And finally, suggestions and key points outside of what I have just discussed to wrap this video up include: if you earn cryptocurrency by mining it, it will count as part of your regular taxable income, meaning you would owe tax on the entire value of the cryptocurrency received, and you would have to pay that tax at your regular income tax rate. The second suggestion, and one thing that I cannot encourage you enough to do, is to keep track of all of your crypto transactions in a spreadsheet. I do this myself, and it is invaluable. Every time I see my accountant, I have every single thing I need to put all of this tax return stuff together regarding cryptocurrency and not have to worry whatsoever about if I'm missing any information or having to go and find information, which can be time consuming. This is extremely important if you're someone who is trading cryptocurrency frequently. My third suggestion, and it needs to be said, is to only invest money you are willing to lose. I know that I say it a lot, but it's one that needs to be reminded and ingrained into people's minds, because people get silly and decide to lose lots of money very quickly if they're not careful. So only invest money you're willing to lose. And my final key point, this is not a suggestion, this is not advice. If you have made a significant amount of money through cryptocurrency and for some reason you've come across this video, move to Portugal. Go enjoy very light-hearted crypto tax laws and enjoy the rest of your days sitting on a beach with a pina colada. Because I know a few people that have actually done this. There are a few YouTubers who have YouTube channels talking about their life in Portugal now based on their crypto investments, and they seem to be living pretty good. So kind of a joke, definitely not advice. Portugal, tax-friendly laws. And there are other countries like that too. Food for thought. I hope today's video was helpful and I hope that you learned something. Make sure to subscribe to the channel and turn on bell notifications so you do not miss any of the videos I release. And with that being said, I will see you in the next one.